What's going on, everybody? It's Armor Bull Trading. There you go. See, I love the logo. All right, let's think about this real quick. We are going to talk about the basics of options. All right, we're going to fling this out. Maximize. I don't know if you guys can read this, but it's on the board. So we're going to talk about option basics, right? So with that being said, I just did a video on opening a brokerage account. So assuming you are approved for whichever level you need, on Robinhood, I believe it's level 3. Webull also, I think it's level 2. Fidelity, I believe, has a level advanced tier. What they call it, I think it's level 3. Anyway, so those are going to be spreads and things like that. But before we get into any of that, it's going to be another video. We're going to talk about options basics. What are options basics? Options basics are literally the principal pieces of options. Now, we're not going to get too detailed in this video. I'm just going to mention what the sort of library definition per se, and then we're going to talk about what we actually do with those contracts, because 90% of the options traders do not do what this does, right? They're not taking advantage of buying or selling the shares at specified prices, you know, unless they really are deep into options per se and have a lot of shares to accommodate with such, you know, contracts or whatever. Forgive the phone for auto adjusting if it does that. Hopefully it doesn't do it too much to annoy you. Thanks for watching. Here we go. Again, Armor Bull Trading. Let's get in. So, buying a call. I'm sure you've heard this a gazillion times. I'm moving out of the way. There you go. So buying a call. All right. So buying a call and buying a put. Well, what is the difference? So when you're buying a call, you're paying the option premium, which is that price that you see on the option chain, which is generally vertical. You'll see it from top to bottom. Often calls are on the left, puts are on the right. Some brokerages like Fidelity, especially on their advanced platform, which I'll show you in a minute, you can actually separate them and have them on one side, or just show calls and just show puts, etc., etc. Anyway, that premium that you pay in exchange for the right to buy the shares, your right to buy the shares at a set strike price on or before a specified expiration date. Now, if you watch any of my videos before this, you will know that I constantly have talked about expiration time, and buying the time is so important. It's way more important to worry about your expiration than it is the specific strike price that you're actually choosing, unless you are really, really in there on that perfect move, you know, right before a breakout or right before a dropout, you know, and you'll kind of get that going. So, call. Now, basic library definition, you can see that in computer minus the last little bit here. But what we will say is, now, buying a put, contract that gives the owner the right, but not the obligation, to sell a stock at a predetermined strike price. So, with that being said, that means if you have the call and you're having shares, you're buying a call, that makes you have the right to buy the share at the set strike price on or before a specified date. Now, here's the thing. If your call is in the money, which means it is below, so say the strike price you have is $9 and it's now at $10 on the stock, you have the obligation, not even the right, to buy that stock at $9. That's your strike price on the call, right? So you have that right. Now, if you don't have the cash to buy said shares, then you're just going to exercise the contract premium and take that value off the table. So basically, you're selling the contract for its face value at expiration. Now, what people don't realize a lot of times is that they'll let their contracts expire and they'll actually lose money, all right? And you actually have a chance of losing all of your investment on this if you let a contract expire. Again, do not let contracts expire. There is little to no reason for letting a contract expire. Just a lot of times it doesn't make sense, not to me anyway, logically. And the reason is, if that stock is trading right around, like, say, I don't know, your strike, remember, is $9 and it's at $10.50, right, on the whole day. The whole day is doing fabulous. But in the last 30 minutes of the day, some news pops out, and all of a sudden all the investors are like, man, that's crazy. And they just start selling off. Or a big institution who holds a lot of shares is like, man, you know what? Let's cut a little dry on that. And they shed some shares, and it causes the stock price to drop because they just want to get out, just in case it gets worse. They already concealed, you know, some profit or whatever the case. And so now you have to worry about having this strike That's at 9 when the stock price was at 10 plus, and now it's coming on down, and now say it's trading around 920. Are you going to wait a whole week if you have a whole week left, 5 days left of expiration, and it's 20 cents away from knocking you out of the money? And guess what? If it's even a penny below your $9 stock price, $8.99, this option will expire at 0. It doesn't matter how much you paid for it. Okay, chances are something that's $9 probably not going to be that much money. It's going to be probably $50, maybe $100 max. But it doesn't matter. As investors, traders, whatever you want to call yourself, your job is to protect the money, right? Of course, you want to make a lot of money at the same time, but you don't want to lose your money, because that is what allows you to make more money. If you're in a bad position, you close it. If you're losing money, you close it. If you're making a lot of profit, you close it. You don't just continue to let contracts run and run and run and run forever, unless you just happen to be in one of those beautiful blue moon specific moments like Tesla or Apple. Say you bought a 6-month contract 4 months ago. You have no idea that they were going to announce splits, and guess what? Now you're holding a fat chunk of money. You could have been a brand new trader and done some just really ignorant things on your account and actually walked away with a lot of money on that situation. So with that being said, if your contract expires under $9, it's 0. You literally lose all obligation, or I'm sorry, all right, and you lose all obligation to the money because it's not there anymore. It goes to 0. That contract, it doesn't matter if it was $99 value at that moment. The moment it dropped below and closed at 4 p.m. or whatever your stock market closes at, that contract is dead. If it's at 9:05, you're still okay. Chances are, from when it went from 1050 down, whole lot of implied volatility kicked in and you lost a lot of money on that contract. Now, I'm not saying you lost money on the contract altogether, because I don't know when you bought the contract. But the thing is, why would you allow it to go so high and then wait for another hour of the day to close, to let it just expire, and give you your right to buy the shares, so you can just, no, I'll take the contract value, or the brokerage will do that for you. A lot of brokerages actually close, I know Robinhood does this, they'll close you at 3 p.m. Some of the other brokerages allow it to run, until 4. The only thing is that can be an issue is when it comes to spreads and things like that. If you get exercised and or just selling calls and puts, you can get exercised. Excuse me. The thing is, you just want to be prepared. And again, we'll talk about kind of more detail of how most option contracts are traded in general. But let's move on to puts first. So that kind of covers calls, right? Again, you have the right to buy the shares at a set strike price on a specified date. But again, if you don't have the money for the shares, you just exercise the essential right to the money of the contract. So whatever the face value of the contract is, that's what you get. Now, for the puts. This is buying a put. You're not selling any options here. Again, this is just buying calls, buying puts. Buying a put, again, a contract that gives the owner the right, but not the obligation, to sell a stock at a predetermined price. So again, the owner has the right, so you have the right to sell the stock at said price. Now, the only thing is essentially the same thing as the call as far as this goes. If you're buying a put for $9, okay, but the stock price is at 10, that means you need the stock price to be under $9, okay? So if it is at $9 and a penny, sorry, you're going to lose the whole value of that contract and your right, but not obligation, to exercise that contract. And again, if you don't have the money to with the share thing, and if you don't have the shares and blah blah blah, you don't have to have the shares to have a call or a put in this case, in this scenario. The only time you have to have the shares is if you're selling a call, which in case one contract is equivalent to 100 shares, therefore you sell one contract, which represents those 100 shares that you have, and you can collect premium on that set of 100 shares for that one contract. And so on and so forth with 500 shares, 5 contracts, etc. So, buying a put, again, contract that gives the owner the right but not obligation to sell the stock at a predetermined strike price. And there's really not too much to elaborate on this outside of what we pretty much said is the opposite of the call side. Going with buying a put, you want to make sure that you are getting in the top of a move coming down, or it's a longer term contract, say 30 days to 45 days to maybe 6 months, who knows. Getting over 6 months is getting kind of pointless to an extent. There's been a fad with these leap contracts, which is a thing. It's a thing. It's been mentioned so many times in this chat that I'm in. It's just so annoying to watch because Most people have no idea what it even means. They just buy long-term contracts thinking that it's a leap. A leap is generally anything over a year. All right, if your contract is like 3 months or 4 months, it's not a leap. Okay. With that being said, leaps have very little purpose unless you're like an investing options trader, right? So that means that you have a seriously high probability of becoming in the money or very close to it at said long distance away. So let's talk about this. So say we're not even going to use anything crazy like Tesla. We'll just say Apple right now after the split, right? So Apple's around $120 right now per share. It went up a little bit to 126, I think, today, and then it kind of fell back down. The market kind of did a little nosedive. Hopefully we get a little more down this week. But say you expect Apple to go to $200 a share by March, right? So say March rolls around and it's at 150. So, well, you're not at 200. So your contract in that last 30-day window is going to really start kicking into theta, which is a Greek. We'll talk about it in a minute. It is just going to just obliterate the value of that contract in that last 45, 30 days. And so then essentially it was pointless, right? So there was a time to where the contract is gaining a lot of value because it's like, oh man, okay, so say, remember March was your expiration, so say December, you jumped from 140 to 150, that's a $10 move. And say that happened in a 2-day time frame. So your contract probably gained a decent little bit of value where you probably could have just closed it and called it a day. Now, where most people fail to do is they will close it early and then they will get just, FOMO, essentially, fear of missing out on, say it jumps another $20 or $30 and they would have made a lot more money. But if it doesn't do that, and again, let's say remember it goes flat across all the way to March, say it stays running that like $5, $10 range, maybe a couple of days it jumps up a little in value, maybe not. But if it dives back down to 120, you're done. Like that contract is going to be trash. So essentially, you're putting money on hold for a possibility that may or may not ever happen. Now, the thing is, when you go like a year out, that gives you a little more range. Okay, so say, you know what, man, I really love Apple, and I'm going to buy these. I'm going to buy these calls for $200, but I'm going to go ahead and buy like 500 shares right now at this $120, right? Because I just know that it's gonna give me that $80 a share later on. So I'm gonna sell calls on these. So again, you have 500 shares, so now 5 contracts. Say these contracts, let's be modest. So you wanna make money if you do have to sell your shares early. So let's say you sell them at 150, right? Remember we got to 150 in December in this scenario. So say you bought them at 120, you're selling calls at 150. Now chances are, because you're $30 away from the current price, it's not going to be a great, premium as far as that goes because it's $30 away from where you are. But chances are, let's say it's, I don't know, $20. Just keep it simple. So you're going to get $20 per contract. Okay, say it's a 3-week expiration. So every 3 weeks, you could do this up until you get ready to get out of these contracts overall. Like say it gets to that 150, now you get exercised. Pretend that you just stayed at 150 because in logic sense, I'm probably losing some of you here, just bear with me. But in logic sense, and once it gets up to that 150 or close to 150, you're not going to continue to sell, the 150 expectation. You're going to go higher than that. You're going to move it to 160 or 170 or 180 as it goes up. And then you're going to be able to collect premium constantly, 3 weeks, 3 weeks, 3 weeks. And chances are the selling the calls premium is going to be higher than selling the put premium. And a lot of times you're protecting shares, selling puts on shares you have if you're selling puts. But you want to essentially assume that the price is going to go up because if you get exercise, and I did this with OPK earlier this year, I had a beautiful expiration. It was fairly long. It was like 3 months, and I ended up exercising. I bought the shares in at like $1.25, right around March, and I ended up getting. I exercised at $2, and it was a nice little contract boost. So I think total on the trade I made right at about $1,200 profit. So that was pretty sweet. But the same principle. It's like you don't want to go too long. But before we get too crazy over here, let's again buying calls, buying puts. This is the basis of options in general, right? Because with these two items, these two legs, these two whatever you want to call it, these two pieces of the puzzle, you can essentially build multiple types of option strategies, right? We're not going to get too deep in all that right now. But other videos can carry those things on, debit spreads, credit spreads, condors, and all that good stuff. But buying a call, buying a put. What are we actually trying to do in this scenario? Okay, Let me go ahead and just minimize this. Here's a Tesla chart for today. This was open, beautiful sell-off candle here. And I went ahead and closed out a position I had, and I waited till about right here when I saw this confirmation. Okay, this is what you call a confirmation. This is a literal support area. Now I don't have any support resistance on here because the way I use this chart that I built, if you've seen my other video, I literally modified this based on ranges and Bollinger Bands. Okay, so this chart is actually magnificent for what it does. So you have your main EMAs here. You got 50 and 200 rolling across. It's very clear. So PMA actually is what I have the yellow, and it's 55. So kind of 50-55 rolled together here. Then I have the shorter term 8 and the I believe it's the, what do they got, 21? Yeah, 9 and 21 EMAs here. So you kind of see where they're respecting the levels, right? But right here, once it dropped below that 50 range, it was kind of like, you know, buyers kind of were like, you know what, let's push this back up, man. We don't want to see it go down anymore. So you see it dipped a little further here, which was, see that candle dip low of 440, okay? And I'm good here because I was not going to cut my losses, you know, until I saw, you know, a moderate drop. Now this one scared me a little, but I went ahead and sold my contract right here for like $1 profit on the one Tesla contract spread I had. And I was like, you know what, I like Tesla, it's still holding up its ground. And once I saw this confirmed right around the end of the day, I went ahead and got into another position. This one is $10 in the money for a debit spread, very minimal. It was only $145, I think it was. And the max profit is $55 because $200 spread, 433, 435. All Tesla has to do is stay over 435 and we're solid. We take that whole $55 off the table. So that being said, it's kind of your chart deal, but we're not looking at that. We want to see options. Again, we talked about option chain. I'm going to maximize this. Now I'm going to keep it brief because Tesla's very expensive, so we're gonna look at it kind of baseline. We're going to show you, there's a lot going on here, right? And you probably can't really see these numbers, but I'm going to basically explain it to you. So on real brokerages, I don't think Robinhood tells you the days, you know, or anything like that, which TD Ameritrade, Schwab, things like that, they actually have, you know, where it shows you the dates and the days, shows you if it's a weekly contract or a monthly contract. Scroll down a little here. A lot of traders, what did I do? I don't know what I just did. Anyway, a lot of traders will only trade, you know, specified option ranges, and they don't like to trade things that are, well, let me get this back opened up. There we go. What in the world? What did I do? Oh, my bad, I'm taking it away. Give me a second. So Tesla also has earnings later this month. It is October, so we're looking forward to that. But anyway, so at the base principle, it shows you the days, right? So if you want to say run that 3-month range, you're going to be looking right around January 15th. And this is a beautiful expiration because as you can see, these people are looking for a beautiful strike range, but we're like, who buys a strike for $5? Like, what is this? This is nonsense. So let's go over here. Let's go to all strikes. And now it's going to get it really, really populated over here. Where's my thing at? So all strikes. Let's see. I want to buy that. Oh, tab that. Stand by. What's going on? Oh, I went to a different stock. No wonder it looked crazy. Sorry about that, folks. Temporary issues here. So now, internet lagging. How's everybody's day today? All right, so let's keep it simple. So what we're looking at. All right, so this is your option chain, okay? This is gonna be real basic here. So currently stock prices that we're on SPY. I don't know why I keep changing my ticker over here. So you're on SPY 350. And you can see that you have all these different strikes to choose from, right? So essentially, we're not going to choose a strike that's $515 because the chances of SPY hitting $515 when it's at 350 is very, very, very almost not possible. Okay, I'm not going to say it's not possible because we saw some crazy stuff over here in the beginning of the year, you know, from March and all that when everything went crazy. But what we are going to do is kind of drag this down a little so you can see what is going on here. I hate touchless keyboards. All right, let me go back again. Type in Tesla. Okay. All strikes, custom range. There we go. So I got on calls and puts. Shows the bid-ask prices. Let me keep scrolling this down. For some reason, it is when you do all strikes. This is why a lot of people don't do all strike, because you have this monster list of numbers that you have to deal with, right? And so you don't want to do that because we're nowhere near those strike prices. But here we go. We're at a normal range now. So let's say Tesla is right here at the money. So you'll see a cross, right? If you can see how the histogram changes color, see the blue here, and you come over here and you see the blue again. So that point right in the middle at 446.65 a share, we're in between 446 and 447. That is our cross point to where we shift from in the money to at the money to out of the money, okay? So in the money is obviously for calls. You know, you're going to be over here. So in the money is going to be anything less than 446. On puts, anything in the money is going to be less than 447, okay? And then you go up, and that puts you in the money. Because what's going to happen if you go to 439, that is, yes, it's decreasing the price of the strike that you're looking for. But the only thing is, will Tesla go down to 439? Maybe, maybe not. Could be a good trade because it's only going to cost you about $500. Now the only issue is you're looking at a very new expiration here. So you're over here on October 16th, and that's why it's so cheap, because it's just not probable. But anyway, it kind of gives you a call put ratio, showing you that that calls and puts are kind of almost balanced. They're getting there. Both sides, a lot of people are really bullish. I mean, look at this. This is a $450 strike price, and it's 20,000 open interest. Open interest are how many contracts are actually there, okay, and how many contracts are open. So that is your basis of an option chain. All right, and again, this was your chart. And again, I was showing you Tesla, and let's look at SPY. But you know what? Let's dig into Tesla just a little bit. Let's go off. Let's deviate a little on this video. Let's go out to a 1 year chart, and we're going to be looking at daily candles now. I'm going to drag this over because I don't think y'all can see. Let's see where I get the side over here. Right there we go. Now the only problem is these candles are going to be really small. So let's go this route. Go a little further over, and we'll get a nice picture in here. Because I need the smallest candle a little higher. Give me a better screen to look for anyway. All right. So here we go. Broaden these candles down. All right. Now as you can see, you're looking at, you can see this rise, right? So the way I made this is like I said, it's literally based on the Bollinger Bands. But it's a very specific way it's based on the Bollinger Bands, and that's a whole nother situation. But as I see this step out, right, into this level 3 area, okay, we can see that it came back and retraced to the 50 level. Again, it pumped up, got into the second level, pumped back down to the 50 level. And again, we shot back up. Now, what we need to realize is every time it gets around this black band, it actually pushes over just a little bit, maybe not too crazy, but the last time it did, we got right here in a similar situation. We had some weak candles, and all of a sudden we had this monster bullish engulfing and just ran it, right? Pumped right up through, and it just rode that wave all the way up, okay? So this is things that when you're technically when you're using technical analysis to trade, you will look for things like that. But again, another video. So with that being said, we're going to go ahead and close this, and we're going to talk about the very simple basics of how we run contracts. Now, you'll turn your attention over here to the board. Go ahead and switch it right there, just a little bit. Hopefully it doesn't fade too much. Again, these are options basics. Okay. So when you're looking at options, right, you're going to choose, again, buying a call. So what do we want to happen when we're buying a call? How do I know what call to buy? Well, if you go with a rule of thumb, okay, because I know a lot of people day trade, and a lot of these stock trading people and chat groups and things like that, often they will tell you buy the shortest expiration, so you spend the least amount of money up front and you get the most profit at the same time, you know, especially if it moves in your direction, because you can turn a $20 contract into $1,000, right? And it is possible, don't get me wrong, but it's a lot less likely than people make it sound like. So say we have, again, let's just, you know what, let's use Tesla as an example. Tesla is at 446, all right? And we'll say 75, just to keep it simple, okay? Tesla's here at 446.75, okay? I think Johnny, we'll say Johnny, and we'll have Elroy over here. So Johnny thinks the stock is going to go to 500 on earnings. Because remember, earnings is later this month. Now, am I telling you to trade on earnings? Absolutely not. We do not trade earnings gambles. If you are a month or two out from an earnings play and you were trying to capitalize on a bigger move, on better earnings, or a huge drop like Ulta did back when they had their earnings, you know, last year, then those kind of things, I mean, to each their own, okay? We can't sit here and tell you, you know, what you should trade, how you should trade it, and things like that. Now, of course, you have chats with signals, which is great, but that is, again, their opinion on where the stock will go. Now, some of these guys are really good, some of them not so much, right? So if you blindly follow somebody, you have no idea what they're talking about, and you just go in there buying your calls and puts or shares or whatever the heck it is you're buying, you may or may not get burned, right? You might get burned really badly, or you might make a little money, or you might make, you know, break even or whatever. But you got to pay attention. So again, this is how the market works. And if you don't know this, you're going to learn this right now. The market works by somebody being right. And again, we got Elroy over here, who thinks the stock is going to go down to we'll just say 400 again to keep it simple. So Elroy thinks it's going to go to 400, okay? Johnny thinks it's going to go to 500. We're right in the middle here. So we have a very equal probability of being right or wrong, but say Johnny is basing his analysis on technical analysis, and Elroy is basing his on fundamental analysis, aka your 10K, your profit, your revenue, your expectations of deliveries of cars in Tesla's, you know, situation, and or getting SpaceX on the road, or maybe getting huge partnerships with such, and those things all really matter. So what you have to realize is that you don't want to be wrong, but you don't want to be right. And there is you know, some of you watching this, if you're experienced at all, or if you've watched any of my other videos, you'll know that I would likely say you could strangle this position. Okay, which means what? A strangle is another more advanced strategy, but it's still very basic, built on your call and your puts. You're going to buy a call, okay, and you're going to buy a put at the same time. Okay, and what does that do? It's going to take both of these values and add them together. Okay, so say both of these cost $200, which is obviously not accurate because Tesla, again, is very expensive. But instead of paying $200 for one call or $200 for one put, you're going to pay $400, okay, and get one of each. So now you have one call and one put, which is a strangle, which is a position. I used to trade strangle. That's the only thing I traded until Trump got in all this retarded crap with China in the trade war, and then it started to not be as as efficient that it was once before. They still work. I've still made, you know, decent money on strangles here and there. You can make them extremely tight. You can make them long. You can make them short. I mean, you don't want to go crazy out of the money because it might not work in your favor, right? So again, you're using the basic principles: buying a call, buying a put. All right, so here, Johnny's buying a call, but Elroy's buying a put. But you know what? Let's say, let's use some different names here. We'll say somebody named Missy. We'll say Missy wants this strangle, okay? So Missy's gonna buy the strangle for 400 bucks. Johnny's got his, so but Johnny's got his, let's see. Johnny's got his $200 call, okay? Elroy has his $200 put, and Missy has her $400 strangle, okay? Now we're gonna get rid of all this. Oh, this blue really gets into the board. Dun, 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 dun. Everybody still watching? Happy Halloween early. All right. So we're gonna switch markers on that note. All right. Again, Tesla 446. Johnny bought his $200 call. Elroy bought his $200 put, and Missy bought her $400 strangle. Boom! Earnings hits October 23rd, after hours, whatever. Tesla says, I'm gonna go to, and this is not a prediction, but let's just call it what it is. Let's say Tesla says, you know what? We're gonna tag out $4.95. It's been a while since we went on a nice run. $4.95. Who made money in this situation? All right. He made money because now his $200 call for $500, depending on his expiration, because earnings is the 23rd, there's an expiration on the 23rd, and there's one on the 30th for this month. So we're going to assume he wasn't a complete idiot and bought the 30th, right? Because even though after hours he bought that, guess what happens? He doesn't get any money, but say that Tesla ran up to 465, you know, and then added that other $30 after hours, he still would have made some money on this contract. And he probably would have closed it knowing that he was going to run out of money at the end of the day because it's going to expire under 500 and he was going to lose his money. But we're going to pretend he bought October 30. Can y'all see that? Anyway, we're going to pretend he bought October 30 expiration. So, with that being said, he is literally $5 away from his strike price, okay? And again, Missy's over here. She made money on her strangle. So the strangle and the naked call, which naked means that you have a solo position. It has no hedging built in. It's not a spread. There's nothing like that. It is solo by itself. Therefore, it's called naked. You're not backing it with cash. You're not backing it with shares. You're not backing it with nothing. You just bought this call or push straight up. So in this case, the naked call would have made money. All right. Say he's got October 30th expiration. He's going to go ahead, you know what, man, I'm taking my profit. Say his profit boosted up because it's so far, so close to the money now. He's $5 away. Say his contract's up $3,000 or $4,000. Okay, boom. He's up, we'll just say $4,000. Okay? Now, the only problem is with Missy's strangle over here, she doesn't mind so much risking a little on the other side. So even though she lost that $200 over here on the put, all right, poor Elroy, he lost all his money. He's done. So October 30th expiration, he lost. All right. He was expecting it to go to 400. It went almost $100 in the opposite direction total, and he's out the game. He's done. All right. He'll probably have 20 or 50 bucks left of that contract. He'll just sell it, sign off, and move on. If he continues to hold it, thinking it's going to drop back to 400, he's probably stupid. So anyway, little Johnny with his $200 call, so he didn't quite get as good, but you know, he didn't break over 500, but he did get $4,000 profit. We're going to leave it at that. So Missy over here, she lost her 200. Okay, so minus 200 on the put. But her call, again, we'll say it made the same $4,000. All right, so she's looking she's happy, right? Now, you just take that other money here. And it's not quite this simple. The numbers change a little bit based on what it is you're trading. You know, put it over here. So, you know, you minus that, so you got your $3,800, right? So Missy and her strangle, and these are not exact figures. This is not exactly how this is going to work. Missy likely in the real scenario would have probably made $2,000 to $3,000. If he made $4,000, she probably made $2,000 or $3,000. Because if it's only a $200 contract, she's not going to lose that much on the downside, right? So say she made the $3,800. But again, good old Elroy over here, he lost it all. Like, he threw his whole $200 away. You know, hopefully he didn't have to pay for his boat, you know, or nothing like that. So now let's get this out of the way. And now let's think about another scenario. But again, this is going to be the simple return of what the opposite of what we just showed. Again, let's assume they all have the proper October 30th expiration. And it's going to get a little more complicated, so hopefully y'all are listening. And I'm running out of time because I know this video is about to end. Because of my time, my camera. So, I got 10 more minutes left. Here we go. So, what happens if Johnny was wrong and Tesla dropped to $3.95? Okay. Ooh, big change here. What happened? Okay, so, well, we clearly know that he's in the money now by $5. All right. That is beautiful for him. So, we're going to say Elroy made, because now he's in the money. He's not just at the money, he's in the money. So we're going to say he made $5,000, okay? Good old Elroy, he's happy now. He's dancing. He's dancing. He made that money, all right? But Missy got some money too. She lost her $200 on her call, but okay, she made $5,000. Okay, and you subtract her $200 here, so now you got $4,800 that she made. All right, and again, these numbers are not going to be exact because this is a completely fake, mocked up situation here. This is not exactly how the numbers work. Generally, options are based on Greeks, which tells you how much the contract will make or lose per dollar move, and or lose daily, which is theta. We'll show you those in just a minute, very quickly. So anyway, so this scenario. So am I saying that a strangle is the best position to absolutely have? No, I'm not saying that at all. And the reason I'm saying that is because they got lucky, right? Because Tesla got right there at their spot. They got right there at their expiration that they wanted. They got right there at the price they needed. But oftentimes, for most traders who trade options, this does not happen. And it is very unlikely for it to occur, especially on earnings, even though most earnings have a huge direction move one way or the other. A lot of times it doesn't work out that way. A lot of times you can have stocks like, I forget which one. As a matter of fact, Netflix. Netflix did it. This is the one that killed me on my position. It actually it lost huge amount of value. It went from 530 to 450, came up to 490, and then just kind of stayed flat for the next 3 weeks, right? Terrible, terrible position I had. But I was 3 weeks shy of making $80,000, so I'm going to let it ride. It happens, okay? So, Greeks. What are Greeks? Options Greeks. Options Greeks. Okay? This, I'm not going to say they're not important, but I'm not going to say that I use them constantly. Now, in some cases, it is very good to know how much you're risking at losing daily if you hold the contract. If you day trade, Greeks are almost, they don't even matter really. In some cases. Now, a lot of traders will really get mad at what I just said. But, in the fact of the matter, if the contract has, say, delta, well, let's list them out first. So you got delta, you have theta, okay? And I have these listed in my book, my first book, very, very short, like 25 pages, get on Amazon for like $9. And I describe all this basic stuff. Delta, theta, gamma, okay? And you have vega, and you have rho. Now, if you know about options at all, the only ones we really actually care about are delta, theta, gamma, and sort of vega. I don't really give a crap about rho. I really personally don't give a crap about vega. And a lot of times I really don't care about gamma either, okay? Now, I'm not going to say that I'm not going to explain those. I'll actually do a more detailed video of the options Greeks in another video. But this is what you want to see, okay? Delta and theta are two of the most important things. Now, this is not a Greek, but this is another very crucial thing when it comes to options. and it is called IV. Anybody tell me what it stands for? We had a light class. Implied volatility. Okay? And there are different kinds of volatility. Can anybody tell me what they are? All right. You're probably saying it out loud on your computer right now. That's spelling right, volatility. Anyway, so you have IV, HV. What happened there? And you have, let's see, historical, implied, and historical, implied. Oh, that's terrible. I'm not even gonna write that on there. Anyway, so you have historical volatility, you have implied historical volatility, and you have implied volatility. And what this means for your contract is that when you get up close to an earnings, and I'm gonna have to cut this video short because I'm running out of time. When you get close to a contract's earnings, a stock's earnings and your contract is running out of time, or you may even have a little time on it, but a lot of times IV will affect the contracts probably within 30 days or so. And what's going to happen is you're going to get an excited premium, is what I like to call it, because the premiums are going to ignite. They're going to start elevating in value based on the possible projected move. Again, we have Tesla earnings coming up, so Tesla's contracts are going to start to increase in value. So if my debit spread that I hold, my expiration is 10/30. Say I held it up to earnings. I'm going to sell it the day before earnings. And I'm going to be like, you know what? Because I actually have one for the 16, but I'm opening another one, tomorrow or whatever. But what's going to happen is if I hold it up to earnings and earnings drops and earnings just goes flat or it goes down, my call debit spread is going to lose money because implied volatility is just going to wreak havoc on that contract. Because a 20% move on IV, you could be up $3,000. And in the morning, when that contract opens, even though you're still in the money, you could wake up to, I'll be realistic here, you could wake up to this, you're still positive, or say it went neutral and IV hit you. Now you could be looking more around this range. So you went from here, could have closed out some serious profit, but you chose to hold through earnings, which is a risk, as anybody who trades knows, and new traders should very much know, that when you trade earnings, you have problems. And you can sell calls and puts and stuff like that and capture a lot of IV, credit spreads, whatever it is that you want. But all I'm saying is you better hope to the Lord Betsy that you do not get assigned on those contracts and or it does not completely just go against you and you really get destroyed on your premium. Now, as professionals have taught me before, you certainly, if you are taking advantage of all that implied volatility, you want to get rid of that contract now, okay? You want to get rid of that contract right now, seal your profit in the trade, call it a day. What we do with calls and puts is we generally just flip the contract's value. We do not really care for the most part about buying the stock at this price or selling it at this price. 90% of us don't do that, okay? I do sell calls, I do sell puts, I do call debit spreads and call credit spreads, and I do put debit spreads and put credit spreads, and I have occasionally done iron condors, but it's not something I'm a fan of as a whole, unless it's something like Ford that literally doesn't move much, 50 cents in either direction for a certain amount of time. Those kind of trades are what you can kind of lock down to a specified value. The way most contract traders trade is literally buying calls and buying puts, buying calls, buying puts to buy the contract at $50, sell it at $60, buy it at $100, sell it at $900, buy it at $5,000 and sell it at $6,000. It doesn't matter. Whatever your way of trading is, the only thing you need to do is know why you're getting in the trade, when you're getting in the trade, and how you're getting in the trade. So that's going to be all for this video. Hopefully this kind of touched base on a lot of things that a lot of people have questions about. I really kind of hope I got into some detail on some things that people don't really understand a lot of times. But if I didn't, there's more videos to come. Coming at you guys. Y'all have a good night.